Hi, this is Michele Green, Senior Vice President in National Agency Operations. You know, we've been talking about wire diversions for a lot of years now, at least 8 years if you can believe it. Sometimes I feel like this issue has become like white noise to our agents, and the messages and the warnings are just not sinking in. This is playing out in the negative outcomes we're seeing suffered by our agents nearly every week over the last few years. It's important to know that both this crime and the messages of warning have evolved significantly over time. Both who's targeted, which funds are targeted, and vitally, your ability to insure against this risk has changed dramatically over these years. When we began years ago, most of all, we were talking about sellers' funds that had been diverted, and this evolved into buyers' cash to close that was diverted. And those are still enormous targets by volume. But where we are today in these last several years, our agents are being devastated by misdirected mortgage payoffs. And they occur when our agents are following the wiring instructions that are embedded in a document that's used in nearly every real estate transaction, the mortgage payoff statement. You know, when our conversations began 8 years or so ago, when we were very first starting to talk about wire fraud, we of course tried to focus our attention on prevention. Beware of changed wiring instructions, call to confirm. Losses continued though, sometimes devastating losses, and we necessarily had to move to a discussion about being properly insured for these losses. When those mistakes did happen 5 or so years ago, when money was diverted, our agents would demand that their E&O policies provide coverage for these losses. After all, an accidental failure to confirm wiring instructions is in fact a mistake like any other, right? It's an error, it's an omission, and we've been paying premium for years thinking that we'd be covered in the event of just such an occurrence. And some policies did provide coverage, but some didn't. Why? Theft of funds exclusions. Theft of funds exclusions have been in E&O policies, since forever. For us as settlement professionals, every policy has within it an exclusion which is intended to be essentially an act of the insured exclusion. It states, excluded from coverage under this policy are losses that are based upon or arising out of the theft, misappropriation, conversion, etc. of funds. After all, who could convert funds in the context of a settlement except for the settlement professional who was the insured under the E&O policy? We got that. We understood. If someone in our office wrongfully stole funds, we certainly didn't expect our E&O to provide coverage. The important thing to note, though, is that not all theft of funds exclusions say at the end of that exclusion 3 important words: by the insured. Why is that important? Well, if the exclusion simply states that there's no coverage if there's any theft of funds, then those E&O carriers could use that exclusion to avoid coverage for wire fraud losses, because somebody definitely stole funds. By the way, many smart settlement professionals were righteously indignant and took their E&O carriers to court saying, hey, that's not what this exclusion was intended to cover. But virtually across the board, state and federal courts have upheld the use of the theft of funds exclusions to deny coverage for wire fraud losses. Well, wait a minute. What if the theft of funds exclusion did end with the words by the insured, making it truly limited to acts of the insured under the E&O policy? How could the E&O carrier then avoid payment for wire fraud losses? Well, very quickly there popped up in all E&O policies that did end with by the insured in their theft of funds exclusion, limiting endorsements and specific exclusions avoiding any coverage or color of coverage for wire fraud losses. So very quickly, like at the very next renewal, when this was all going on 6, 7, 8 years ago, these new exclusions and limiting endorsements made it crystal clear that E&O policies are not going to cover losses or very limitedly cover losses associated with wire diversions. And that's where we are today, folks. There is no coverage for wire fraud losses under your E&O policies in the general market today. Anyone who believes that their E&O policy will protect them if their office fails to confirm wiring instructions on a mortgage payoff, and your escrow account is left short by hundreds and hundreds of thousands of dollars or more, will almost certainly be mistaken about their insured status at their hour of need. When this became clear 5 years or so ago, there quickly then sprang up a market for wire fraud insurance, insurance that was actually intended to protect your office and your business in the case of a failure to confirm wiring instructions. This was excellent for settlement professionals. I mean, we know we're supposed to confirm wiring instructions, but what if someone forgets? What is available in today's market to protect your company relative to wire diversion? Well, it's limited. You can still purchase coverage now that essentially says, if I call to confirm wiring instructions at a known safe phone number and the fraud still occurs, I have some sort of limited coverage, usually no more than $250,000 or so. This limited coverage also provides litigation defense insurance for those situations where buyers are attacked and their cash to close is wired elsewhere when they think they're communicating with you. Yes, that gets our agents sued all the time. And those policies that do provide this limited coverage, yes, you're still not going to get coverage for failing to confirm wiring instructions, and we do know that calling will probably avoid the loss in the first place, but these policies are still important, and frankly, they're not that expensive, if for nothing else than that litigation defense insurance against when our buyers get attacked, because we all know that they're continuing to fall for these frauds, even when we continuously warn them. Having said that, based upon what I'm hearing in the insurance market, it's likely that even this limited coverage will be exiting the market in the next several years. There's simply no carrier in the world who wants liability for these mortgage payoff losses when folks are not consistently confirming the lender wiring instructions. So where are we today? I can't say it more plainly. If your office fails to confirm the wire instructions associated with any wire transfer, but in particular, if your office miswires a mortgage payoff to a fraudster in bare reliance on a mortgage payoff statement or otherwise, you are not insured for this loss. You know, in all matters of risk management, if you cannot improperly insure against a risk, you must work to avoid it or transfer it or share it. What does this mean? Well, we have to double down on our efforts to prevent this loss in the wiring of funds, particularly these large mortgage payoffs. Many agents maintain a list of account numbers to where they've safely wired mortgage payoffs before, and they use that list to confirm the accuracy of the wiring instructions they've received on the mortgage payoff statement. If there's no match on their safe list, then they have to call to confirm at a known safe phone number and not the phone number that's at the bottom of the mortgage payoff statement that might in fact be fraudulent. If that's untenable or impossible, they're sending checks by overnight delivery. It's as simple as that. No small extra step of confirmation or cost of an overnight delivery is worth being left liable for a misdirected mortgage payoff. Beyond that, there are companies in the market today whose business it is to provide settlement professionals with verified wiring instructions for payoffs. Many agents are moving toward companies like this to help transfer the risk of validating mortgage payoff wiring instructions. These companies have their own insurance with strong financial backing in the insurance market, providing coverage of usually up to $1 million a year if you use their validated wiring instructions. It's certainly something to consider. Let's face it, most agents would buy insurance to protect their businesses against wire diversion losses if they could, and perhaps the funds that might have been used to purchase that insurance could be budgeted towards using services like these that are financially backed and are sharing this risk with you. So there you have it. The news isn't good. It never really is in the area of fraud and wire diversion, but it's best to be informed. So thank you for your time and attention today, and thank you as always for trusting FNF with your business. Take care.